All right, let's talk Limoneira. They just dropped a pretty wrong quarter, but honestly, the real story here isn't what just happened. It's about their big two-track turnaround plan that's kicking off right now. So we're going to break down both of those tracks and figure out what it all means for the stock. So right off the bat, this is the number that just jumps out at you. A 25% drop in revenue year over year. I mean, we're not talking about a small miss here. This was a major, major blow to the top line. And it really came down to two things: weak lemon prices and just lower avocado volumes. And, that hit to the top line, it just tumbled all the way down the income statement. You see it right here. Revenue fell from over 63 million all the way down to 47.5 million. Adjusted EPS, it swung from a nice profit to a loss. And adjusted EBITDA, wow, it completely cratered, going from almost 14 million bucks to just 3 million. This is just a perfect textbook example of operational leverage working in reverse. When your sales fall, your profits fall way, way faster. Okay, so with numbers like that, management has to have a plan, right? And they do. It's a two-part strategy. Let's dig into part one first, a complete overhaul of their core citrus business. So the absolute centerpiece of this whole fix is a pretty big strategic move. What they're doing is handing off their citrus sales and marketing to the Sunkist Growers Co-op. The idea here is simple. Leverage Sunkist's massive scale to streamline everything and just aggressively cut costs. And there's a hard number attached to this Sunkist deal. They're targeting about $5 million in annual cost savings and EBITDA improvement. But, and this is the really key takeaway for anyone watching the stock, you have to pay attention to the timing. This big benefit isn't expected to really kick in until fiscal 2026. So there's a bit of a wait. Now, it's not just about what they're doing internally. On the earnings call, management pointed out that they're expecting some help from the global market too. They're seeing supply issues in some really key growing regions, think Turkey and Spain, where they're dealing with freezes and other weather problems. The bottom line? That should create a much better pricing environment for lemons as we head into 2026. All right, so that's track one, fixing the core business. Now let's get to track two, which honestly might be the more exciting part. This is all about unlocking the hidden value from assets that have absolutely nothing to do with the volatile produce markets, their real estate and their water rights. And when I say hidden value, I mean it. The scale here is just staggering. The company is expecting to pull in $180 million in cash from just one real estate venture over the next 7 years. Let me put that in perspective for you. That is more than half of the company's entire market cap right now, all from a cash stream that doesn't care one bit about the price of lemons. It's just incredible. And get this, it's not even just that one project. On top of the Harvest development, which, by the way, is already selling homes ahead of schedule, they just announced they're looking at a new residential development in Ventura called Limco Del Mar. So what you're seeing is another major long-term catalyst being added to that real estate pipeline. Okay, so let's recap. We've got the fix for the core business, and we've got this huge real estate cash flow. So what's the third piece of this puzzle? Well, it's the long-term organic growth driver, avocados. This is where the company is literally planting the seeds for its future expansion. And they have a really clear roadmap for this. Right now, they've got 700 acres of avocado trees that are still young. They're not producing fruit just yet. Those are going to mature over the next 2 to 4 years, but that's not all. They're also planning to plant another 500 acres between now and 2027. So what's the result of all this? They are on track to nearly double their avocado producing acreage. And management is circling 1 year in particular, fiscal 2027. They see that as a potential breakout year for volume. All right, so let's put all the pieces together. The tough quarter, the citrus fix, the real estate, the avocados. Here's our take on Limoneira heading into the next call. So our rating on this is market perform. The feeling is, cautious but constructive. On one hand, you just can't deny the headwinds they're facing right now. But on the other, those long-term catalysts, the Sunkist deal, all that real estate money, and the avocado growth, they're just too credible to ignore. This is really a classic show-me story. We need to wait for proof. But okay, if the rating is just market perform, you might be thinking, is there actually a trait here? How would you even pitch this to an investment committee? Well, here's an outrageous but plausible pitch for you. A long position, but with a 24-month time horizon. The whole idea is to just look past all the near-term noise in fiscal 25 and 26. You're basically buying the stock today to capture that big inflection point in fiscal 2027. That's when you'll see that major surge in avocado volume hit, layered right on top of the steady real estate cash flows and a much leaner citrus operation. It's really a bet on management's ability to execute this multi-year turnaround. So that's our breakdown of Limoneira. Really, the question for any investor is pretty simple. Can you stomach the near-term pain to capture that potential long-term value from the avocados and the real estate? We'll definitely be watching their execution very closely. And as always, this is not financial advice.